Hi everyone, this is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years, ever since I found him at Casey Research, where he was a former mining analyst and Big Gold newsletter writer. He's now the senior precious metals analyst at goldandsilver.com. Jeff Clark, thank you for joining me today.
Jason, I'm glad to be here.
Now, Jeff, I want to ask you about the gold market and demand for physical gold. I think we're at around $12.48 gold price right now. There was record physical gold withdrawals in November 2016 and February 2017 from the Shanghai Gold Exchange. Yet many mainstream gold organizations like the World Gold Council, GFMS, etc., claim gold demand is weak. What's your take on demand for physical gold globally?
That's a great question because I think there is some misinformation out there. First of all, a lot of the reports that you see, these headlines you'll see, those reports are looking at the very short term, or they're cherry picking the time frame. They're basically looking at a short-term dip in demand in the midst of overwhelming demand for physical metal. So just as an example, let's have some fun here. So which number is bigger, 985,000 or 801,000? Well, it's obvious, 985,000. That's how many gold eagles were sold last year. In 2015, it was 801,000. So demand rose tremendously just on gold eagles, just in the United States. So demand in the big picture is up. It's elevated. The story is really that demand remains elevated, not that it's having a short-term dip. And just for comparison, we should talk about the Shanghai Gold Exchange, the withdrawals that you mentioned, because in 2016, there were 63.3 million ounces of physical gold withdrawn from the Shanghai Gold Exchange. And if you look at a chart, you'll see, wow, it was actually down from 2015, and it was. But the point is, it was the fourth highest amount on record from the SGE. So the story is, like I said, demand remains elevated. It's not really going down all that much. I mean, a lot of this is just short-term blips. Demand is still very, very high overall, especially when you look at the picture historically. In fact, demand is still so high that you know how that you'll see the headlines in India about imports are down, gold imports are down, the government's doing their cash restriction thing, and they're trying to tax gold, and they're raising fees and all this stuff they're trying to do. Well, that's having an impact in India. And so what one of the largest refiners in the country is doing is they just started a major gold recycling program because they can't get enough bullion because demand is still up. So even though you read these headlines that demand is down supposedly or is restricted in India, it's actually still up because in India a lot of that market has gone underground. And that's not reported. And so, we have evidence of that, not only of the people that are constantly being caught, but this major refiner, the biggest in the country, had to start a recycling program for people to bring in their jewelry so they could recycle it to get more gold. So there's lots of stories like that. And so in the big picture, I would ignore the short-term headlines you see. Demand is elevated. And here's the other thing. I'm not really worried about it because demand is going to shoot back up and go even higher in the next crisis. And whatever that crisis is, however that plays out, whenever that happens, the next set of crises could be very big, and that's clearly going to push gold even higher than where it is now.
That's a very interesting point you brought up about Indian gold refiners having to recycle physical gold because they're having trouble sourcing. We know from Jim Rickards and other people visiting Swiss refiners that the Swiss refiners are essentially running 24/7, 365, and a good amount of the bars that they make, the 4/9 bars, the kilo bars, are all going to China, and they're not leaving China. And I've heard interviews with Swiss gold refining CEOs saying, they don't want to add any more capacity. They've been thinking about maybe adding more capacity, but they're running basically at full amount right now, and they're having some trouble sourcing large amounts of physical gold in quantity to refine. But you brought up the point there about the mainstream media. I think, Jeff, unfortunately, the mainstream media they have a lot of clickbait. A lot of their bias is very anti-gold. They have an I don't know why, but they have an anti-gold, anti-silver, and anti-Bitcoin bias. So whenever the paper price of these things, any of those three things falls, it's like, oh, now the market's going to crash. I see these headlines all the time whenever the price takes a little dip, like you said.
They might actually be a good contrary indicator when they think it's falling or something like that. And if the price has declined, that's probably a good, short-term buying indicator. So I tend to, poke fun at these guys because they really don't get the picture. And you're exactly right. They have a clear bias toward gold, physical gold, silver, Bitcoin, anything like that. And here's the thing, that's probably always going to be there. It's always going to be there. I remember being interviewed by NPR in 2011, and I think it was like the spring. And if you remember, some of your listeners, I'm sure remember, that was the peak in gold. And even in that interview, NPR was, every single question I got from them was a skeptical question. Well, why is gold really rising? It's not really going to do this. It's not going to stay up. It's really not a store of demand. I mean, every single question was negative. In the midst of gold being the #1 asset performer over that prior 10-year period, even in the midst of that. So I guess the message is, hey, get used to it. They're always going to be that way, but it doesn't really matter because a lot of people instinctively know that they can protect themselves with gold and silver. They will come back to this market in droves in the next crisis. And depending how big that crisis gets, demand could be overwhelming.
Yeah, and if the Federal Reserve does increase interest rates a couple more times in 2017, we could have a stock market crash in the near future. The oil price looks like it may fall a lot further. If we have an oil market crash, that could, fall. That could trigger a stock market crash as well. So there's a lot of, I call them economic landmines out there. And, owning physical gold and silver for insurance, I think outside the system is very smart.
Absolutely. Absolutely.
Well,
go ahead.
Well, Jeff, I want to ask you now about the gold to silver ratio. It's around 71 for the gold to silver ratio. Do you think this means that silver is a better long-term value relative to gold at this point?
I would say that it is more attractively priced right now than gold, yes. Obviously, when the ratio is in the 70s, that means silver is undervalued compared to gold, especially when that ratio has been down to 20 and even below 20. So, if you look at history, the ratio right now, whether it's 70, 71, 69, 75, it doesn't matter. That a ratio in that range is far above the average for almost any time period in history that you look at, whether it's a 10-year time period or a 100-year time period. It hit 17 in January of 1980 at the peak of that bull market. And so actually, if you think we're going to have another bull market, you should anticipate that silver will outperform gold at these price levels. So we're likely headed somewhere in that gold-silver ratio, I think, before this is all over. I think it's very likely that we'll hit 20. And possible that we'll go even below 20. So yes, silver is definitely more attractively priced right now. I personally don't own just silver, though. I do own a mix of both gold and silver. I caution people about buying only silver because it does have a high industrial use. 56% of all silver is used in industry. And so if we have some type of deflationary depression, and the government can't inflate its way out of it, which is what we think will happen. But if they're not able to do that, oh, wow, the industrial use of silver could suffer. So, I mean, I definitely own lots of silver, but I don't own only silver. So I just want to make that point. I'm very bullish on it, but it's not the only precious metal asset I own.
Great point. And yeah, people shouldn't go all in on anything in the environment we have where the politicians and central bankers, it feels like they keep changing the rule every 6 months or a year, whether it's quantitative easing or interest rates or capital controls in many different countries. So, going all in and betting too heavily on just one thing is very dangerous in this environment. Now, I want to transition to the gold and silver mining industry. I know you covered this extensively at your prior job. Do you think that in general the industry has done a good job at cutting costs in order to survive since gold hit 1900 and silver hit 48 in 2011 and a cyclical bear market started?
That's a great question. I'm glad you brought it up because there's a lot to say about this. There's a lot we could talk about. I've written a lot about this, but just briefly, if you look at the cost structure in the industry, every analyst out there has a different number for the average quote unquote cost to produce an ounce of gold, but the most reputable ones are around about $1,200 an ounce, give or take. And what I'm talking about with that figure is the total cost of mining, not the headline numbers you see, our costs are down to $800 an ounce now. What I'm talking about is the entire all-in costs, including taxes, interest on payments, exploration costs, everything. If you add it all up, the average is about $1,200 an ounce. Well, with the gold price today at, would you say, $1,248, I think it is right now?
Yeah.
$48 in profit? Wow. I mean, how much money are they really making at the end of the day? They're not really turning a true profit if gold isn't above $1,200 an ounce. And they've been cutting costs for over 5 years now. Gold started going down in 2012. They were forced to cut costs. How much more can they cut after 5 years of cutting? That's debatable. There's not a lot they can do. The only thing they left to do is actually close a mine, because a lot of them have already laid off exploration staff or development, staff or something like that. So there's limited room for them to cut much further than what they're already doing. And since they're spending less, less on exploration and development, there's going to be less supply coming to market, and we can talk about that. But as far as costs, some companies are still closing projects. We just saw in the news this month, Sibanye Gold is stopped production at the Cook 4 deposit because the mine was unprofitable, and here we are at $1,250 gold. So this is still happening in the industry. Costs are still rising at some projects too. In fact, if you looked at all of the producers in South Africa, you averaged out their costs for the year. Costs there in South Africa are 8% higher this year than they were last year.
Higher labor costs, right? Because of the mining unions is one of the factors probably.
Labor is a constant problem over there, and also electricity, and also they have other issues there. I mean, South Africa, it's really an issue of adapt or die. They have to incorporate more technology and greater safety and all these kinds of things to go deeper and deeper in those mines and still get the gold out. They still have a lot of gold there. The issue is getting to it and getting it out safely, and that's what they've really had a problem to do. So that's still an issue there. So the bottom line is costs are kind of stagnant right now. They're not really going up, going down as an industry, but they're higher than most people realize because they're not counting everything in to the cost of producing an ounce of gold with those headline figures that you see some companies put out. And so therefore, the gold price really can't go too much lower. These companies are really going to be pinched into a corner.
Yeah, I agree. The industry can't really raise that much capital right now in terms of debt and equity. They can raise some, but not enough to bring on, large and expensive new mines. I think it's a cautionary tale, Jeff, of this Rainy River mine that New Gold brought on. It was supposed to be economic at the current gold price, but the capex on the mine, it went from $800 million to over $1.2 billion, and now the mine is not economic at all, and yet New Gold has to still sink costs into it to bring it online, and they're going to run the mine basically either at cost or at a loss.
I was really disappointed because I know the head guy there, and I've met him. I liked the company. I liked their culture. I liked Rainy River when it was first discovered. I owned the stock, but when I read that, to be honest, I sold the stock. Because I just see too many things have to go right in order for that to be successful. That has this kind of thing has implications on supply, and we can talk about that. But the real issue is that in that particular circumstance, the gold price is just not high enough for them to make it economic. So I was really disappointed. I still like them, but I sold the stock. It's not a good bet right now, and I'm sorry to say that.
Yeah, and I think, a lot of mining company executives agree with you. They're not willing to make large investments into new mines right now. I mean, maybe they're spending a little bit of money if they're eking out a profit on some exploration stuff, but they're not considering, multi-billion-dollar capex expenditures on a large mine. I think, Jeff, there's only a handful of new mines at current metals prices that are being either constructed right now or going to be built in the next couple of years. We have Mag Silver down in Mexico, but Fresnillo is basically fitting a good portion of that bill, and they're the operator, and that's a really high-grade, low-cost project. We have Pretium Resources and Mariana Resource. The Pretium Resources is in Canada, and Mariana Resources in Turkey. There's not many more projects than that. It seems that like a lot of the potential mines, Jeff, are they're lower grade, they're higher capex, they're very marginal, and they need a much higher gold and silver price to be economic, and we're not near the gold and silver prices that these new mines would need.
That's exactly right. That's a very good summary. That's exactly right. Costs aren't coming down that much. The amount of new gold that's coming to market is not there. In fact, here, let me just look this statistic up real quick. Let me just tell you this real quick. The amount of spending on gold exploration over the past 4 years is down 64%. In 4 years, the amount of money they've spent looking for gold is down that much. So obviously, if you spend less looking for gold, you're going to find less gold, and it's really happened. The amount of newly discovered gold has really collapsed since 2006. So over the past 10 years, the amount of new gold discoveries, the amount of ounces of new gold that's economic in reserves that can be mined at by a company has dropped 85%. So we've only discovered 15% of the same number of ounces of gold as we used to discover in 2006. So there's all kinds of implications with that. That's had impact on the reserves and everything else, but the point is that the costs and the amount of gold that's available have really crimped the industry big time.
Yeah, in December 2016, Bloomberg ran a very interesting story showing how primary gold miners are running out of economic gold reserves. I think it's an important story that our listeners should go read. I'll put the link to the article in the interview in the info section of the interview. Do you think the industry can replace reserves at current gold and silver prices, or will gold and silver prices have to go substantially higher to maintain current production levels and also to replace mined or depleted reserves?
Well, that's a good question. You're talking about a big picture thing. It's not something that happens in a month. It takes years for these kinds of things to develop. But we've been in a bear market for 5 years. I actually think we're starting in the beginning of another bull market here. But the point is, costs and the gold price are about the same right now. So reserves have fallen dramatically. So the number of reserves since 2011 are down about 40% industry-wide. And obviously part of that is because the price of gold has made a lot of this uneconomic. But it doesn't mean necessarily that when the gold price goes back up, let's say it does go to 2,000 a couple years from now, you think, oh, okay, well, all that gold that was there is economic now. No, that's not necessarily going to be the case because of what's called high grading. So most deposits have both high and low grade ore, and so what management teams have been doing is they mix it to get a consistent grade going through the mill. But when the gold price dropped, they started mining just the high grade portions so that they could still turn a profit, show lower costs, things like that. Well, so all that's left is the low grade stuff, but the low grade stuff in many of these projects doesn't work unless it's mixed with the high grade ore. It's just not economic. It's too low grade. A gold price of 2,000 won't make it economic. Gold's going to have to be more like at $3,000, $4,000, $5,000 to make it economic. So it's having major impacts on the industry. I do think mine production is peaking. I do think that the amount of new supply coming to market is going to fall, and I'm obviously not the only one that's saying this. Most analysts are saying this, and the banks that cover the industry are saying the same thing, and it's going to last a while. It's a long-term, big-picture trend that's going to last for at least several years. I even read a report just last week about a bank saying they think the supply deficit will last till at least 2022. So, it's here. The supply crunch is here, and it's going to have a greater and greater impact as we go forward.
Yeah, and I think the supply crunch could be even more for silver because so much of it is used in industrial demand. It's competing with investment demand. There's not a lot of above ground silver other than what's in SLV, although SLV, isn't independently audited every single year, so there's not a large above ground stockpile. And then a lot of the industrial demand for silver is not really recycled. Only like 20-25% of all the annual silver production is recycled each year if it's used in industrial purposes. So I think there's going to be very big supply problems for silver in 5 years or less, unless the silver price maybe gets to $25 to $30 an ounce to start getting the exploration going. A lot of the potential new silver mines, Jeff, it looks like to me, primary silver mines, they need at least $25 to $30 an ounce silver to even consider maybe raising some money to build a new mine.
That's true. There are exceptions, but for the most of them, that is true. They're going to need much higher silver. This $16 silver price isn't going to cut it. They've been cutting costs for 5 years. They can't go much lower. The industry knows it. The analysts know it. The banks know it. So it's a real concern. And the issue with silver is, there was almost 1 billion ounces of silver in new supply last year. You think, wow, that's a lot. Well, no, because there's not a lot of above ground silver. A lot of silver we do have does get used up, as you pointed out. So you need to have new supply continuing to come to the market to meet demand. And so if we have I go back to this idea of a crisis. If we have a crisis and people rush into silver, not just you and me and your listeners, but a lot of the mainstream start to rush into silver, there's not going to be enough to go around. There is going to be a supply crunch. I totally agree with what you're saying.
Well, it depends on the price. So, I mean, if silver goes to $40 or $50, there'll obviously be more supply available. But at the silver price we have now, $17.50 or so.
No, I disagree. I don't think $40 or $50 silver is going to bring new supply online immediately. It's going to take a much higher silver price. And the reason is because it takes years for mines to go from discovery to development to production to commercial output. It takes years to do that. So yes, it'll start to lead to new supply, and maybe some scrap will start to increase, but silver's going to have to, double and triple from where it's at now before that really takes place. Remember, a lot of these management teams are a little nervous. They're scared to jump into new projects because they got burned big time in 2011, 2012, 2013. They got burned. They're not going to commit millions and millions of dollars to a new project until they see not just a higher silver price, but a sustainably higher silver price. They have to be convinced, the miners themselves have to be convinced that silver is high enough for me to make a profit, and it's going to stay high for years in order for me to continue to turn this profit. They have to see that before they're going to commit all this money. So it's going to take a much higher silver price and a sustainably higher silver price for supply to really reverse.
Those are great points there. The silver market is very interesting. I want to ask you now about the all-in sustaining costs. Nolan Watson and Brett Cook kind of got in a debate over this. Nolan Watson said some of the CEOs in the industry were dishonest. I think part of it was, you mentioned earlier in the interview about the cash costs. I've looked at hundreds of different presentations of miners of all different sizes, juniors, producers, exploration companies, mid-tiers, senior miners, and they would all list the cash costs, and then you would go compare them to the financial statements, and the cash costs never match the financial statements. For a retail investor, they wouldn't necessarily do the comparison. They would see the cash cost and say, oh, this miner should have really good margins when gold was at 1900, but when gold was at 1900, a lot of miners were barely eking out a profit. It seems their costs were rising faster than the metals price was. So do you think the industry is cleaning itself up and being more transparent and honest with this all-in sustaining cost measurement?
I think they are being more transparent, and they are cleaning themselves up because they have to. It was either adapt or die. If they didn't cut costs, they weren't going to be in business very long. You can only go so long where it costs you, $1,800 to produce an ounce of gold, and the price of your product is selling for $1,200 an ounce. So they had to. As far as transparency, yeah, I did like the move when the industry went several years ago to the quote unquote all-in cost for production. But again, like I was alluding to earlier, that doesn't necessarily include every single penny that is spent by a miner. Specifically, all-in excludes taxes, and it also excludes exploration and development costs, exploration costs. So you add those two things in, and that's how I come up with this $1,200 figure. And again, I'm not alone. There are many analysts that, if you add up every penny that is spent, divided by how many ounces of gold they're selling, there it is. It's $1,200 an ounce. So I did like the move. I think they're trying to be more transparent. A mining company is like everybody, though. They're always going to put their best foot forward. And, in some cases, if they don't have to reveal it, they won't. But I'm hopeful that we're moving in the right direction, if I could put it that way. I do think I'm going to make a lot of money, quite frankly, in gold stocks. So, I'm careful about the companies that I choose, but, I think we're moving in the right direction. Let's put it that way.
Yeah, I interviewed Rick Rule in 2016, and he said the companies don't count their write-downs. He said that they should include the write-downs for any bad assets or bad investments in their cost of production as well. So he said that the figure should be even higher than that because they don't capitalize their costs. So that was an interesting view there about the industry underreporting extra costs as well.
Yeah, so not everybody would agree with that statement, but generally speaking, I do. The point is, no matter what you include or exclude, if you add it all up, the costs are higher than many people realize, and what you at least see in headline numbers from mining companies.
Now, you talked about high grading mines earlier. I know you've covered mining companies for a long time. In your estimation, how much of the industry do you think are high grading at their mines? Do you think it's prevalent? Do you think it's a small percentage? What's your opinion on this?
I would say it's common. There are obviously exceptions. There are many companies that have high grade deposits that they don't need to high grade because everything they have is high grade. There are companies that have only low grade deposits. So, all they can do is try to cut costs otherwise. But most veins pinch and swell. So you'll have low grade ore, then you'll run into high grade ore, then you'll run into low grade ore, then you'll run into high grade ore. So a lot of these projects and a lot of mines, and every mine is different. It's like a person, the DNA, everyone's different. Every mine is different, but that's a common trait with many mines. And so this is a common practice to mix ore from high grade and low grade projects and deposits in order to get a more consistent, and that's really what miners want. They want a consistent grade coming out of the mill so that analysts can project and predict and say, okay, this is what we can expect, and so therefore let's buy this stock because we think it's going to go up because we can count on this amount of gold coming out. So this is a common practice, and not everybody that is high grading, but it's prevalent. It's commonplace. It's happening a lot. So you add that and all the other factors up that we've talked about, and it's going to have an impact on supply, on new gold supply.
Yeah, I agree. I think it's going to be very tough for the industry to replace reserves and also to bring on new mines if metals prices don't for gold and silver don't rise significantly in the next couple years. About high grading, from what I've learned, when they release the mining plan, they mix the high grade with the medium and the marginal grade to extend the life of the mine. So, initially when these mines got funded, some of them had 10, 15, 20-year mine lives, but that was mixing the grades. So if they've been high grading, the mine lives on some of these mines, the mine life could be cut in half, and the cost could be a lot higher than those economic projections were when the mine was built.
Exactly. It's a combination of both fewer ounces that are available, that are economically available, and the cost to get those ounces is much higher. And so those two factors require a much higher gold price. And again, it's not just a higher gold price, it's a sustainably higher gold price. Look, I've talked to a lot of these miners. I've met with many of them over the years, and they got burned. They're scared. They want to see a gold price that is sustainably higher before they're going to commit millions and millions and millions of dollars.
Yeah, I agree. And your father was a gold miner, and I've done a video last year naming a dozen different problems in the gold mining industry. The average retail investor, Jeff, I don't know if you agree with this, they don't understand all the things that could go wrong with a mine. Once it's being constructed, once it's in production, flooding at the mine, the costs at the mine unexpectedly rise 20, 30, 40%. The government, if it's in a foreign country like Bolivia or another foreign country, could change the tax consequences. Mexico just did this for silver miners, I believe. So there's so many things that the average retail investor doesn't understand that could go wrong at a mine. So this is what makes buying a lot of individual mining stocks dangerous.
It is. Mining stocks are definitely risky. They are a speculation. I like your list there. I agree with that. There are many, many things that can go wrong. And frequently many things do go wrong. I should write an article and list all the things that could possibly go wrong. The only problem with that is I might never buy another mining stock myself. So I don't know if I want to do that. But
well, I own the royalty and streaming companies. I like Silver Wheaton and Sandstorm Gold and Franco Nevada. I think most people should own those along with physical gold and silver first before they go and buy regular mining stocks. That's just my opinion, though.
Oh, absolutely. I mean, the core of anyone's portfolio, in my opinion, should be physical gold and silver, not a paper product, but physical gold and silver. You want to own that, and not numismatics or rare coins or anything like that either. You want to start with bullion. You want to get at least up to 10%, in my opinion, of your portfolio in physical gold. This is the time to be overweight. And then if you have some extra money and you want to speculate, yes, stocks are an interesting way to do it. The only thing I would say about the industry now, what's happening now is, and this dovetails with everything we've been talking about, and that is the miners don't have a lot of production capability. So what that means is they're going to have to go out and buy it, which means M&A, mergers and acquisitions, is probably going to increase in the years ahead, which means if you own some of these high quality juniors, you could see a nice payday because they're going to, the majors are going to have to go out and get ounces to produce. That's what they're in the business to do. And if they're running low on ounces, they're going to have to go out and buy it, because to bring a new project online, like I said earlier, takes many years to do.
They have to be careful with that. There was a good article that was on Seeking Alpha about that. Brent Cook was quoted in the article. And basically, a lot of the larger gold miners, Jeff, like you said earlier in the interview, they've written off about 40% of their reserves because they're a lower grade and marginal higher cost. So they already are carrying a lot of marginal deposits that can be built at a higher price on their books. So those juniors that people are going to speculate on, they better have high grade. They better have low cost potential mine. If they don't meet that criteria, if they're very marginal, well, the larger miners already have marginal deposits that can be built.
Of course, there's a lot of factors that go into picking a junior miner, because now you're at the high risk table. So you need to have a project that is big, that has lots of ounces, at least 1 million, preferably 2 or 3 million. It needs to be economically feasible, meaning there has to be a scoping or preliminary feasibility study done on it. At least it has to be in a safe political jurisdiction, which is only where I invest. It has to have good people behind it. everything you've named and more. There has to be something you have to really do a lot of due diligence on. But some of these companies are going to be bought. They're going to have to be bought because the industry just is not prepared to maintain their current production levels or increase them, in the current environment.
Yeah, I completely agree. And I don't even know, Jeff, if the production can be replaced if gold were to go up to 1350 or silver to go up to 25. I think you're right that we're going to have higher sustained metals prices because the mining company CEOs, the stock price on some of these mining companies, it dropped more than 80% from peak to trough after the bear market started. So and they almost got ousted as CEO. They almost lost their company. So they're going to be very apprehensive to bet basically when a junior or mid-tier miner brings on a new mine, they basically have to bet the company on the mine if it's a large mine. So it's a very dangerous proposition to bring on a new mine.
It is. It's not a great environment to do it. If you have the economic and the financial ability to do it, and you're a reasonably safe political jurisdiction, and you have strong people behind it, it might be a good bet. But there's definitely risk, and this is obviously not the most ideal environment to be trying to do that.
Now, you mentioned that you had looked into a few mining companies that you like. Do you care to name a few of them for our listeners to go and do extra research on right now?
Sure. These are speculations, though, so you have to understand that they're high risk. They're early stage. I own them, so you should be aware of that. So if a lot of people buy them and the stock price goes up, I'll be happy. So you should be aware of that. They do carry some risk. So everyone should be aware of that, and it's not appropriate for everyone to invest in these kind of things. But there are several that I'm excited about. I do own a lot of gold stocks. The reason is because I've worked in the industry. I know a lot of people in the industry. I've been an analyst for a time period now, so I feel comfortable with the risk I'm taking. It's not necessarily appropriate for everyone. So with all that said,
you sound like a lawyer, Jeff. With all the
I know I hate doing that, but I just don't want someone to go out and load up on some stock and then lose money on it. They have to understand that it is a speculation, So anyway, these are ones that look pretty darn good. One is Gold Mining Inc. It's the old Brazil Resources. That's a gold explorer. They have various projects in the Americas. It's run by Amir Adnani. He's also the guy running Uranium Energy Corp. So that's a company I'm pretty excited about. Another one is Integra Gold. That is a junior gold explorer in Quebec, one of the safest political jurisdictions you can be in for mining. They just announced a high IRR, internal rate of return, on one of their main projects there in Quebec, and they keep finding more gold. I think they're a good takeover candidate. I do own a lot of that stock, so FYI. And then you and I exchanged some articles there, and one of the articles talked about a Cisco Mining and how attractive they were, and I agree with that. I do own that stock. I think there's some very good potential on that. I will be upfront with everyone. I've already got a 5-bagger on that stock, so just be aware of that. I've already made 5 times my money on it. But I haven't sold one share, and I continue to hold it, and I plan to hold that for a while because they're an early-stage explorer, also in Quebec. The geologists behind that company have had a ton of success. I think there's a lot of potential there. They just bought a lot more land. So there's a lot of opportunity there with that company. They could be around for a long time, and I think they will. So those are just a few that I'm kind of excited about, as an analyst who likes to speculate and has the ability to do that, and the tolerance and the emotional, ability to do that. If you have those things and you want to speculate with a portion of your funds, those are some names to consider.
Okay, well, I'm sure our listeners will take your information, and they will hopefully do their own due diligence and not just go and buy everything just because you said it. Go out there and do extra research. But I want to thank you for your time today, Jeff. I enjoy reading your articles. You do follow the industry very closely, and it's a very interesting industry considering what's happening in the global economy. I think, I agree with you that the gold and silver bull market has restarted. I would have liked to see higher gold and silver prices sooner, but I think the paper markets are still manipulated. But as long as there's strong demand for physical, the manipulation will slow down, and there will have to be higher prices.
The manipulation will end at some point because it has to. Because once the demand for physical metal overwhelms the paper traders, that's the end of that game. So I don't worry too much about the manipulation. Yeah, it ticks me off like it does everybody. I get angry about it, but there's nothing I can do about it, and so I don't worry about it. I think their game will end at some point. What I focus on is the big picture. The risks in our economy globally, really, at this point in history, are so high that it's really imperative that you have a significant portion of your portfolio devoted to physical bullion. That's my opinion. I mean, think of all the reasons why someone might own gold. Okay, so you have, let's say, you're worried about dilution of the currency. Well, we have that. You can check that box off. Why else might you own gold? Well, the debt's too high. Check. We have unbalanced fiscal budgets around the world. Check. Fear of a currency crisis or fear of high inflation. Check. Fear of a stock market correction or even a stock market crash. Check. Fear of a recession. We're now at the third longest economic expansion between recessions since World War II. Fear of a recession? Heck yeah, check. Geopolitical conflicts? Check. Real estate getting bubbly again? Check. War on cash? Check. I mean, the list goes on and on. Well, you couldn't, write a better script for a better time to own gold than right now.
Yeah, I agree. The fundamentals for gold and silver keep improving, but the paper markets for gold and silver went down. But I think the miners are more important than most people realize for the manipulation, because the manipulation, they can fight a gold and silver rising to certain price levels, but they can only defend a price for a certain amount of time before the miners, cannot produce metal at a certain price, and then the price has to be allowed to rise. So I think, we're in a mining situation where for maybe a little bit longer, the miners can kind of tread water, keep their heads above water at current prices, but there's no way the industry can survive at $1,250 gold. I mean, we're going to have to see $1,500 gold in the probably 2 or 3 years, just so that way there's more exploration budget and reserves are replaced. And I think we're going to see 25-30 silver minimum too before any money starts getting invested in replacing reserves.
Yeah, and just think, at those prices, that's when people start to get interested. And so even at those levels, we're going to go significantly higher in price with both gold and silver, because that'll be just the beginning of when the mainstream starts to get interested. So it's going to be an exciting time over the next 3 to 5 years.
Yeah, I completely agree. The paper price will go higher, but I'm just saying for the actual miners to actually start, investing and pulling the metal out of the ground, those are the minimum prices we're going to have to see for new mine construction. A lot of the projects, I'm sure you've looked at these, a lot of the projects that could potentially be built in the next handful of years, none of them are anywhere near economic at current prices. So there's a handful, there's always an exception. I named a few of them earlier in the interview. If you didn't, or if our listeners want to go back and listen, there's only a handful so far that meet the criteria that are economic at current prices. I think a lot of the low-hanging fruit, unfortunately, is gone.
That's a good way to put it. The low-hanging fruit is gone. Not just the miners, but in terms of deposits themselves, the easy ounces are gone. So it's tough. It's going to be tougher going forward. Absolutely.
Great. Well, I enjoyed this discussion, Jeff, about the industry. I want to have you back on in a couple months to talk about the industry. We've had some really interesting comments from the CEO of Silver Wheaton recently, the CEO of Franco-Nevada and Gold Corp about peak gold. So there's really interesting thought leaders in the industry And I think it's important to follow the comments of these guys, especially the financiers like Silverween and Franco-Nevada, because, you know, the banks aren't doing all the financing anymore. A lot of the miners are having to look for new creative ways. So if the guys who are financing the mines don't want to make investments into new projects, so they're waiting for higher prices.
That's right. And I know we didn't get a chance to talk about it, but Franco-Nevada's passing on, you know, buying new royalties on gold projects because they just don't see a lot of opportunity for success there, or these mines maybe aren't going to get built or be all that economic, and so they're passing and going over into oil and gas. So it's a big issue, and it's going to have an impact going forward, definitely.
Excellent. Well, I appreciate your time, Jeff, and I definitely want to have you back on. I enjoyed this discussion.
Absolutely. We encourage everyone to check out, by the way, The Hidden Secrets of Money by Mike Maloney. That's who I work for now. We spend about $250,000 a year developing these educational videos. They're like movies that you can watch. So just Google Hidden Secrets of Money by Mike Maloney, and you'll really enjoy that. They're very, very educational. They're very well done.
Yes. And your articles can be found at goldsilver.com/blog.
Yep, I write a newsletter, and we are also doing some how-to or educational type articles as well. So there's a whole we're really focused on education at Gold Silver. That's a big thing that Mike Maloney really wants to be done. That's why I was hired to do a lot of writing for them. So you'll see lots and lots of great resources there. That's what Mike is all about.
Mo and I are trying to raise $1,000 per month for our Patreon account. We have over 2,600 viewers per YouTube video, so if we can get most of our loyal listeners or all of our loyal listeners to donate $1 per month or up to $5 per month, which would be amazing, that would cover most, if not all, of the money that we need. So we also accept one-time donations if you go to the wallstreetformainstreet.com website. We accept donations in cash via PayPal. Fiat, you can donate there. You can donate Bitcoin through our Bitcoin wallet there on the website, or you can donate gold and silver. We have a gold money account, and we also accept mailed donations of physical gold and silver. Thank you guys for listening, and we appreciate any and all help. Please forward it to friends. Okay, bye.